Dr. Ira Silver is ready to come to the stage, ladies and gentlemen, and talk to us all about the 2012 economic forecast and its impact on remarketers. We'll take a break right after this, but ladies and gentlemen, a nice warm welcome for Dr. Ira Silver.
Thank you, Charlie.
Thank you.
Is my mic on? Yeah, I guess it is. That sounds pretty loud. Okay. Before I start, I'd like to tell you a little story. A biologist, an engineer, and an economist are arguing about God's profession. The biologist said God was a biologist. He created life out of chaos and confusion. The engineer says, no, God was an engineer. Before that, he created the heavens and the earth out of the chaos and confusion. The economist says, no, you're both wrong. God was an economist. Who do you think created all the chaos and confusion? I'm going to try to not create any more chaos and confusion and tell you what's going on in the economy and the industry. If I can get my slides working. Okay, that's working too well. Okay, here, let me take my coat off, get a little more comfortable. Okay, typically at about this time at the beginning of the presentation, I'll go into talking about the economy. Often I look way back 40, 50 years and see what's going on in the economy. Today I'm going to start a little differently because we've gotten some really good news about what is basically the raw material of the auction business, and that's new car sales. New car sales in February hit 15 million units, way above what anyone would have expected just months ago. New car sales have recovered, where looks like, even 60 million will be at reach in a year or so. So the raw material of your business and our business has been improved to the point of basically almost a full recovery. So now let's take a look at the recent past and what's going on in the economy. 2011 was a very difficult year. Oil prices at the beginning of the year soared to a 2-year high on the crisis in Libya. Debt ceiling debate. Remember the debt ceiling debate? We're going to probably have another one soon. Got fairly scary. S&P stripped the U.S. of its top credit rating. There was an earthquake, a tsunami, and a nuclear disaster. Europe had all sorts of problems with Greece and a financial crisis. Interest rates for Greece bonds and Spanish bonds, Portuguese bonds went up, very, very high, two, 3 times their normal rates. And then to cap off the year, we had floods in Thailand that affected supply chains, particularly in the auto sector. Yet, there was no double dip. The economy kept growing. Let's see if, even though there was a significant slowdown in the first half of the year, the economy picked up and it continued growing. Very encouraging. This is sort of everything went wrong, and yet the economy kept growing. But growth has been weak. If you look at the growth rates, except at the very beginning after the worst of the recession, which is here, some very big negative numbers, growth has been weak. Question is why? Why has growth been so weak? I think the most important reason is this lack of a housing recovery. And we've seen, I think, much more of a recognition that this is the problem. The Federal Reserve and the President are trying to do things to sort of goose the housing recovery, get it to pick up. And there are signs that it's getting a little better. There's been a drop in government spending. All this talk about government spending, the deficit, government spending has been declining, particularly at the state and local level, but recently at the federal government level. And this is one of my fears, that if they do too much of that, that could prevent this recovery from turning into a self-sustaining expansion. That could be a problem. And there's been a weak employment recovery, a very weak employment recovery. We lost about 8 million jobs during the recession. We've gained close to 3 million back. So we're way back. We're way in the hole still. Here's a graph that looks at the three things I just talked about. The green bars are real GDP, and the yellow line is housing starts. And as you can see, real GDP declined a lot and then came back, and now it's higher than it was at its height before the recession. Housing starts decline a lot and stayed there. And this doesn't usually happen. Normally, housing picks up when the economy picks up. Often it picks up earlier than the overall economy. So that has kept one of the main reasons that the economic growth has kept low. This is an interesting chart. Just recently put it together. You see the same green in real GDP, but this is government spending. Now, government spending increased a lot during the recession and even a little bit after the recession, but recently it has dropped down fairly sharply. So the government, as opposed to helping the economy, is now sort of dragging the economy. So the government's become a drag on the economy. And I know there is a debt and a deficit problem, but the economy has to recover before we address that completely. And it looks like we're probably addressing it perhaps a little too soon. But you can ask me about that later if you like. Okay. Employment, again, similar picture. Employment collapsed. It's come back a little, but nowhere near where GDP has come back all the way. So these are areas in which the economy hasn't made it. Even though the economy is growing, the economy hasn't been able to get back to where it was in these three areas. Question is, why no hiring? Hiring is important. Obviously, people need jobs to buy cars, to buy houses. So hiring is sort of the starting point. So why has hiring been so weak? Again, the numbers have gotten a little better recently, but typically hiring will pick up a lot more than it has in this recovery. There's a number of reasons. I'll go through them. One, we haven't had strong demand growth. Demand spending has been held back. During the recession, spenders, consumers cut back very sharply on spending, started saving a lot, and they've continued saving a lot. There's been strong productivity growth. Firms cut a lot of workers, layoffs during the recession, found out they don't need as many workers. They figured out ways to produce without hiring. So they're not hiring until they absolutely have to. There's a lot of uncertainty. I talked about some of that uncertainty with the debt ceiling debate. There's uncertainty about taxes. We have election uncertainty. We have a whole slew of uncertainty in the United States. New debt ceiling discussions. So companies faced with uncertainty tend to, postpone decision making. So let's not hire now. We'll hire once we know what things are going to look like. European uncertainty. You've all been reading about all the problems with Greece and the almost default or semi-default that Greece went through and the potential for other problems. So that's another uncertainty that companies don't quite know how it's going to all fall out. And there's other hot spot uncertainty. And this is the thing that probably scares me the most. And I'm really focusing on Iran. Because Iran, a military confrontation, which I'll talk about a little later, would cause the type of oil spike that really could give us a double dip, another recession. I don't think it's going to happen, but it could. So what's going on right now? Or almost right now. One of my major measures of what's going on now in the economy is something called the Institute for Supply Management Indexes of manufacturing and non-manufacturing activity. And as you can see, manufacturing activity, the yellow line, It goes back, they've been calculating this since, I think, 1947 or so. And that's at a level that is consistent with a growing economy, similar to what it was in the mid-aughts, similar to what it was in the mid-90s, and in back periods in which the economy was certainly not in recession. The green line, which represents services, and services are now a much more bigger part of the economy than manufacturing, is even at a higher level. And that doesn't go all the way back. So the ISM indexes are very supportive of a growing, expanding economy. The GDP, and you saw this chart a little earlier, growth did accelerate from 0.4% in the first quarter to 3% in the fourth quarter. So the economy, GDP, real GDP, is growing at a reasonable rate. Employment is even growing. These are the declines and increases. Each bar shows the change in employment over a month. And what was going on during the worst of the recession is we were losing 800,000 jobs a month. Now we're gaining, the last 3 months, we've been gaining about, I guess it averaged about 230,000, 240,000 jobs. This jump up and the decline was related to the temporary census workers. So after the slowdown earlier this year, growth in employment has picked up. But we need a lot more growth in employment to get the unemployment rate back down to 5 or 6%, what most people would think would be full employment. So it's going to take, even at 230,000 a month, it's going to take years to get back to what we would call full employment. So hopefully we'll start even seeing bigger increases, but certainly better than negative 700,000 to 800,000. Unemployment. These are initial claims for unemployment insurance. It's a weekly series, and we take a 4-week average to smooth it out a bit. That's back to around the levels that it was before the recession started, in the 350,000 range. Also are very encouraging. So many of these major indicators of current economic activity show an expanding economy. So the question is, what's going to happen in the future? We know what happened in the past. We know pretty much what's going on right now, but obviously we're interested in the future. If we look at how the household circumstances, households' debt service levels, this is how much they have to pay out of their income for mortgages and car payments and credit card payments, is down back to the 1993 levels. So households have deleveraged. So they're not spending that much yet, but they're in a much better position to spend. Now, some of that deleveraging was due to foreclosures, but they are now paying a $1,000 rent versus a $2,000 mortgage. They may be in a lot smaller, place, but their debt service is a lot less than it was. So in a much better place to spend on things other than houses. Bank credit. This is the Federal Reserve takes a survey of bank loan offices and asks them, are they tightening standards? What percent are tightening standards? When it goes negative, it means they're loosening standards. And as you can see, for both for business loans, consumer loans, and mortgage loans, they are either not tightening anymore or loosening standards. So bank credit is more available. This is probably the biggest positive about this recovery. I showed you sectors before that didn't recover as much as GDP. Corporate profits is one area that has recovered much more than GDP. Corporate profits are at record levels. We're starting to see that in stock market prices. I don't know what it's doing today, but Dow's over 13,000. The S&P hit 1,400 for a bit, I guess, yesterday, and the NASDAQ's back to 3,000. And that's reflecting record corporate profit margins. And that's related, in a sense, to not hiring. So one of the reasons that corporations are doing so well is they're selling a lot of merchandise all over the world, and they haven't really hired that much, so costs have been kept relatively low. Low interest rates have also helped them. Corporations have done a massive amount of refinancing at extraordinarily low interest rates. So the corporate sector is in really good shape. And you can see that when you look at corporate cash, non-financial corporate cash. Companies have not been spending, they've not been hiring, and they've just sort of been keeping the profits. So non-financial corporate cash is at basically record levels. Up over, it's over it's about $2.3 trillion, which is a lot of money. Now, in time, they're going to spend this. Shareholders are going to say, well, you've got all this cash, either give it to me, invest it, or buy back stock. And all those things are going to help the economy. Any one of them or all of them together will help the economy. Banks are in good shape, and we see that even under the stress test, most of the banks came out pretty well. And banks have been keeping, the Fed has created a lot of money, and the banks have gotten that money, and they've been keeping that money at what we call excess reserves. That means money that they could loan out if they wanted to, but it's now deposited at the Fed. And it earns, I think, about 0.25% interest. But for a number of reasons, one of the reasons is they have to face stress tests, they're keeping this capital. But this is capital that ultimately will add to the growth of the economy. You never see a graph like this. I mean, when I first drew this graph, I said, that's amazing. Typically, banks don't keep excess reserves because you don't make any money on excess reserves. I mean, you want to lend out. The Fed never used to pay interest, but 0.25% is not much more than zero. But when the financial crisis hit, they wanted to build as much capital as possible and as much reserves as possible. So they went from basically zero to 1.5 trillion in a very, very short time. So this is an amazing graph. But these, as I said, will ultimately be spent. And that will drive the economy going forward. Other things out there is that the Fed is determined, Bernanke and the Fed are determined to get the unemployment rate down. So they will do what's ever necessary, and they've been doing what's ever necessary within their power. We have potential fiscal stimulus. Actually, the top part of this graph is from an earlier presentation, which was before the tax cuts were extended, the payroll tax cuts, and I had forecast, I had expected them to be extended. I also think there'll be some type of extension of the Bush tax cuts. A lot of people are afraid in 2013 there could be a tremendous tax increase because we go back to the old tax rates. I don't think that will happen. I don't know who's going to be president. Either of them will not allow tax increases of the magnitude that you would have if we went back to the pre-Bush tax cuts. It'll be different depending on who's president, but it will be some type of extension of the Bush tax cuts. I'm very convinced with that. So what worries me the most about the economy? Okay, this is number one. A serious military confrontation in the Middle East, probably with Iran, and disrupts oil supply for a sustained period. So we're going to get much higher oil prices, and they're going to stay high. That scares me. That's probably the worst that I can come up with right now. That could happen. Premature federal budget cutting, I think it's possible. I showed you the decline in federal spending. If they do too much early, that could be a problem. Problem is, if you cut the federal budget so much that the economy goes into recession, the deficit actually gets bigger. You sort of defeat the reason you're doing it. Now, once the economy is growing faster and can sort of go on its own, then you can do that. So they could do too much too soon. Again, a lot depends on what happens with the politics, who wins in both the Congress and the presidency. And Europe. And Europe, has never bothered me that much. What the Europeans have done recently suggests that they're willing to put the money behind keeping the Eurozone and the European Union together. So they've put a lot of money in stabilization funds to prevent any contagion from Greece's problems, and Greece seems to be under control right now, too. So those are the things that worry me the most. When I talk about deficit cutting and what's going on in Greece and Europe, the question comes up, can the U.S. default? Obviously, Greece has, bond holders of Greek bonds are not getting anywhere near what they were promised when they first bought those bonds. They're getting a major haircut in terms of the principal and interest payments. Could something like that happen to the United States? Well, the United States actually can't default if it doesn't want to. If you can legally print money, the money your debt is denominated in, you cannot involuntarily default. And that's the United States situation. It's nice to be able to legally print money. Think of how much easier your businesses would be if you could legally print money. Yeah. I always dream about that. So if you're the Fed, that's why these guys are happy. They can legally print money. Okay. You can involuntarily default by deciding not to pay the interest and principal on your debt. And that's what happened with the debt ceiling debate. They said, we're not going to allow them to borrow any more money, so ultimately the government's going to have to not pay interest and principal on the debt or cut every other type of expending out. But that shouldn't have been discussed. That's not, a bond is a contract. The United States should fulfill its contracts with people who buy our bonds. If you cannot print money, the currency that your debt is denominated in, you can default, and that's what happened in Greece. Greece can't print euros. The European Central Bank prints euros, and mostly based on what the Germans want. So I like this one. That says spendicus, which is a good description of Greece and the problems they've gotten into. Okay, but I believe that things are going to get better and we have better times ahead. I expect the growth actually was 1.7. I had forecasted 1.5 to 2%. It was 1.7, right in between, but they revise these numbers often. I expect next year to be 2.5 to 3, and 13 to be 3.5 to 4, assuming we don't get some draconian cut in spending, government spending, but I don't think that'll happen. So let's talk a little about motor vehicles. Obviously, that's a great interest. Here, what I've looked at is I've compared what goes on with light vehicles sales and housing starts. And if you look historically, housing starts and light vehicle sales sort of overlay each other. When the economy is doing well, they grow a lot. When the economy goes into recession, they decline, and they come out of those recessions very strong, except for this period, this last period. The auto sales have come way back, and housing, until very recently, has been way down. It's certainly nowhere near where it was. So this shows that our industry is performing certainly much better than the housing industry. I'd rather be talking here than at a housing builders convention. There wouldn't be as many good things to say. Okay. I expect the growth to continue. I expect 14.5 million on an annual basis this year, which I've expected for a while. Everyone thought I was wildly optimistic, but since it's been more than it was 14, I guess it was 14.2 or something like that, and then 15.1. So this looks certainly attainable, and I expect an increase of about 7% next year to 15.5 million units. Used retail sales have been growing at a fast clip. Also, not as fast as new sales. Used are less cyclical. They go down less during recessions, and they obviously come up less during recoveries. People who trade down during the recession and then trade up during the recovery. But I'm looking for about a 4% increase this year to 40.5 million, and another 5% increase in 2013 to 42.5, which sort of gets us back to sort of our higher levels of the mid-aughts. Now I'm going to talk a little about auction volume dynamics. What drives auction volume, at least, and I use this sort of thinking when I do my forecast. Past week new sales into fleet and leases negatively affect current auction volume, because those are they happen somewhere in the past, and then they come back to the market and go through the auction channels. But it's past new sales. We know that's actually happened already. Current strong new and used retail sales positively impact current auction volume. So recent auction volume has a negative and a positive. It has the negative of the past weak sales, but the positive of the current strong sales. Now, if we look in the future, the dynamics are going into the future. Recently, we've had stronger new sales into fleet and lease. Last year, certainly this year, to some extent even the year before, 2010, second half 2010. That's going to positively impact future auction volume. And I'm forecasting strong new and used retail sales which positively impact future auction volume. So while the recent auction volume has a negative and a positive, to some extent offsetting each other, future auction volume has two positives. So I'm optimistic that we're going to see increases in auction volume. Now, typically now I would show you what my forecasts were and show you the numbers that we got from the 2011 survey. The survey numbers haven't been finalized yet. So I'm not going to be able to show you those numbers now. They should be available fairly soon. And then we'll have forecast released also. Bottom line is that barring a serious military confrontation in the Middle East that disrupts oil supplies for a sustained period, so it's got to be big increase and it's got to stay. So, if it's just short term and it goes away, that's not going to cause a recession. The economic recovery will strengthen, and I think it will. So this could happen. This is my worst fear, that there is an attack on Iran to take out their military capability, and then we get a big military confrontation in the Middle East. I don't think it's going to happen, but it could. Auto sales will approach past levels. When I talk about past levels, I'm talking about the 16 million level, as housing and labor markets improve. I think this is the year, probably the second half, that we see the housing market really start moving. I think once people realize that, one, house prices aren't going to go down anymore or not much more, and two, that mortgage rates are going to start going up at some point, not too distant future perhaps. Because if you looked at it, long-term rates have been moving up as the economy strengthens. People will say, we've got to buy now. What's happened is the expectation of declines in house prices has kept people out of the market. Rents are getting much higher. The calculus of buying a house is so much more positive than basically it ever was. It's just this fear of potential declines in house prices that's keeping people out of the market and the labor market. And auction volume will increase this year and next. So I don't know what the exact numbers are, but I have an increased forecast. I don't care what what we ultimately come up with the numbers. we're going to see better numbers this year than we did last year. We're going to see better numbers in 2013 than we saw in 2012. And that's the end of what I have to say, and I'd love to take questions. I like questions.